Hey everybody, JJ here, back again for another Saturday of Zoom networking. Just got home from Orlando, Florida, Pace Morby Squad Up Summit. Oh my God. Had 202,000 people there at least. Um, you guys been on my calls before. You've heard me talk about Pace. Our guest speaker today is out of Pace Morby Sub 2 community, and this guy is a true rock star. He's highly respected in the community. Um, he's just an absolute genius in my mind. His expertise is the tax field, and he got into that because he needed it, so he mastered it. He's a Sub 2 student. He started as a student, has become an investor, an entrepreneur, and now is a very successful entrepreneur and highly respected within Sub 2 for his expertise. My good friend, our guest speaker, my friend Tousif Rahman. Tousif, how are you, my friend?
Doing good. Thanks for having me here.
Hey, it's a pleasure, brother. I'm excited to hear about what you got, and I know a lot of people are too. Hey, so we met through Sub 2, but let me ask you, for those that don't know you, where in the country are you located?
I'm based out of Northern Virginia, just outside of DC. So,
Perfect.
anyone in the DMV area, I typically go to the Manassas meetup. If you ever be here physically, would love to shake hands sometimes.
So, our topic today is effective tax planning, and we all know that's crucial to our business as real estate investors because we want to save every dime we get. Really quick, brother, we all start a different way. I want to, get your story, how you got started. You and I talked about that a little bit, but I want to share that with the group. We have a process of education, and part of our process is, learning and picking this up. Our education starts at different ways. What I mean by that is we're driving at 16, we're voting at 18. At 21, we can go into a restaurant and get a ball, get a cocktail order, a drink or something. Where in your life from your teens to your 20s did you get into real estate? As I understand, um, and let's talk about your background for a bit. You're actually from another country, is that correct?
Yes, I'm from a country called Bangladesh. It's a small country in Southeast Asia.
So you were there for your teens, and is that where that's where you started with your engineering with your college, is that correct?
Yes, I studied in one of the most prestigious universities back home. It's with Bangladesh University of Engineering Technology. So we create some of the brightest minds, even some of the biggest companies like Google and Microsoft go to our campus and have the direct hires out there.
Wow, wow. Um, so you got your degree in Bangladesh, you came back
Mhm.
to the state, or you've come to the States now. Um, were you doing engineering when you first got to the States?
Yes. I have an up and down situation. I started with a very small startup in Virginia. I was pretty much all the engineers. I was the architect, mechanical, electrical, civil, because that's when you don't specialize in anything, you try to do everything. So
Yeah,
that was my situation at the time.
kind of like real
Um,
estate.
of course, but real estate is a little bit different because you get more experience doing more things. But especially in the engineering side, the lower you know, the more vast your field is. That's when you actually understand what am I going to be doing. Then I worked there for about 8 months. Then wanted to start businesses. Even in my teens, I was trying to build other businesses. I used to tutor people on science and maths. I used to be pretty good at it. And also, I was building a business for honey. I mean, of course, that was not scalable. I was taking it from the actual collectors who used to collect the raw honey, natural honey, and sell it to my dorms. That was my first business venture. And along with tutoring kids, that's another one. We used to be treated as the smartest people in the country. I mean, I'm not going to say I'm one of them, but I have been with some of the, I would say, geniuses that I have met in there, especially being in the dorms. And came into US about 6.5 years ago. Started a little bit of engineering side, um, then wanted to build businesses and didn't know anything. So I started almost 7 businesses in last 6.5 years. I
Wow.
made money in three, lost money in four. That's how life is.
Let's flip into real estate. I know you got quite a background. Um, and we touched on this when we spoke earlier, is you found out about certain how did you find out about real estate? Did someone tell you about it? Were you watching Bigger Pockets? Did you just
That's a great question. I was looking for legal ways to reduce my taxes first. So in my first year, first time paying taxes, someone messed my stuff up so much. I was on the verge of bankruptcy, but I couldn't do it being an immigrant. So I was luckily able to hold myself up and then started looking into different avenues, one thing leading to another. And then I realized the most tax efficient way is the real estate. It was about 3 years ago when I then first started following different people in YouTube, started Jerry Norton, Chris Crone. I actually found Pace around August of that year, um, especially during the COVID when everything was almost done around 2020. So I joined Sub 2 towards the end of 2020, close to 2021. Uh, and or it might be 2020, end of 2021 as well. And since then, I have a few creative deals under my belt, but my main focus has been to help business owners out with taxes legally so that they don't have the same issue that I personally had once.
I I I like that legally. Yeah, I like that.
Yeah,
So,
because
I mean,
otherwise you're gonna be in bigger trouble. Like that's I feel like one of the biggest difference between I don't know what most people think about Trump. You might not like him, but one of the things between him and Beyonce was Beyonce had to pay $2.5 million to IRS, but Trump didn't end up paying anything. He probably is gonna get caught up with the other stuff, but on the tax side, he was really good.
yeah, and we've heard that before as a real estate investors, one of the great benefits of real estate done properly is if we have someone like yourself or a good tax person, we can actually pay very little, sometimes no taxes, which is part of why we've got our call going today. Um,
Absolutely.
so how long you been sub two now?
About 2.5 years now.
How
So
how'd you find out about sub two? I
to
can't.
be honest, I don't have much money, so just like someone else, I realized I think it was Andrew or Chirag as well. We I wanted to be in real estate because by that time I understood that real estate is the vehicle that you can legally save quite a bit of taxes. But I personally didn't have enough money to actually put the 20% down route. That's when I was trying to find out what other ways, one thing leading to another. Initially, I joined Chris Crone, then I joined Cody Spurvers. After that, from because on Cody's course, there's a very small portion about the creative finance, but then realized that Pace has an entire thing of creative finance. That's how I realized that, hey, maybe this is something that I need to learn more. And one thing leading to another, I'm in sub two.
Yeah, and I know, and recently, probably because you're on the call, you've been so visible. You've been talking about tax stuff. People are asking about tax stuff. So, let's jump right into your topic, effective tax planning. I mean, uh, what should we be doing? What should we know? This is something. I've got a great tax guy, but we as real estate investors, people watching on YouTube, what do we need to know? What are the things that are important for us?
Sure. So let's structure this in two different ways because as I know we have a lot of real estate investors, but many of us have not only real estate but other stuffs as well. So realistically, most people that I have met has had small transition period from W-2 or 1099. They have a small business, then transition to real estate. So one of the biggest things that I personally recommend people to sit down and bog your tax professionals. It's good to know that you have a great tax professional, but you need at the end of the day, on IRS's perspective, you yourself are the one who's responsible for the taxes, not your tax professional. So one of the things that you need to be proactively doing is to do the things throughout the year that IRS is going to want you to do. Now, when I have heard mixed reactions, because a lot of people say that, hey, you should not be working on these to pay low taxes. But I feel like that's a very shallow minded, because the reason we in the developed world are getting those benefits because those are the things that essentially move the economy. So if you do what is good for the economy and the country, that's exactly why you're going to be getting those tax benefits for. And I feel like leveraging those tax breaks and benefits are going to be the most patriotic work, because at the end, your actions that you're doing is what is actually growing the economy or driving the economy in the first place. And that's when the planning phase comes in. I know we consider the tax preparation towards the end of the year, but once you go take your documents to the tax pro in January or February, there's not a lot of things that can be done, to be honest, because your time is already up. So that's when the effective tax planning comes into play, because if you're not planning, or if you're failing to plan, you're actually planning to fail. Because essentially what you're doing is, if you're not making the choice is making you. That's just the life is. There's no way around it.
I hear, about people paying quarterly on their taxes. I guess that's planning somewhat. Um, I recently engaged a bookkeeper. I know that's an expense for me. Not everybody can take on that expense, but I've asked my bookkeeper if we could review on a monthly basis what my income and expenses are so we could prepare that. Um, how do these things fall in line with some of the things that you suggest for your clients?
That's a great question. One of the things is, you took the very first step is review things monthly. That's one of the really important things. I have another subject student who I was talking to. He makes about 750 to $1 million a year in one of his businesses. And I'm like, hey, that's great that your business is doing that. What's your net? He's like, I don't have any idea. My CPA knows it. Now, if your CPA is the one who knows it, how are you going to be planning properly on your real estate side to legally not pay a lot of taxes in the first place? So that's where the tax planning side comes in, is review your numbers, understand what your liabilities are going to be, and then do the things that needs to be done throughout the year to maximize your profit, minimize your taxes, and maximize your outcome, and even make things more efficient. So to summarize in one word, is between what the relationships between these two is the management. Because if you can manage your money in a proper way, that's the entire first thing of proper tax planning. And you would be amazed how many people, whether in real estate or outside of real estate, I have filed taxes where he made $460,000 and did not pay a single dime in taxes this year. And he's also in sub two.
Wow.
And on the other hand, who made significantly less, about 130-ish, and he's going to be looking at about an additional $25,000 on taxes. And he was not using any efficient planning. He was not leveraging any of the structures. And another thing, to be honest, it might sound strange, is real estate might not be the vehicle for everyone's tax planning. It might be for some people, but not for everyone. That's why there is short-term rental loophole. Now, I understand that a lot of people here are listening to real estate people like Pace, but Pace is full-time real estate guy. Same thing with Grant Cardone. Probably heard him in Squad Up. For him, everything in real estate is beneficial. But if you have a 400, $600,000 W-2, I spoke with another substitute student who invested with Grant. He has a negative K1 of almost $80,000, but he cannot take it against his W-2 just because his income type is not structured properly.
What does that mean? A negative what?
Negative K1.
Okay,
So
what
that means,
now, okay. I am really dumb about some stuff, right? I'll admit that. Ideally, we probably have some people on the call that might have the same question, and people on YouTube weeks and months down the line watching the call. What does that mean, a negative K1?
so negative K1 is pretty much saying that this is the partnership that you have, and this is the loss that you are going to be supposed to get. Now,
Okay.
you take that loss against your personal income, showing that, hey, this year I made this loss, even though I made such money. So ideally, it should have been having a lower tax bracket. Now, with real estate, you have something called depreciation or something that's paper loss. So that means it's not actually a loss that year, but on paper, IRS allows you to claim that as a loss. That's why the negative loss with K1s, especially in the real estate, is so lucrative that you invest into. So, say, for example, even in any syndication, you invest into that as a limited partner, or even some cases, if you're active, maybe in general partner, then you get a K1, which is the partnership return, just like a 1099 or W-2 version from a partnership of a business ownership. And then from that negative K1, you take it against your personal one, which is typically the 1040 on your personal side, and try to say that, hey, I made much less money, so tax me less.
Yeah.
So that's the entire purpose of this K1, even though you might have been making cash flow over the year, even though you might have an appreciating property over the year. And that's when also the 1030 exchange comes into another play. You will hear big guys like that's why Pace says I'm never gonna be paying off a sub two loan. Why is that? Because the longer it is, the less taxes you pay. And even if you want to sell it, you just 1031 exchange into another property and not pay the capital gains on it. So especially when it comes like if you don't do that, let's talk about another client of mine. He's based out of New Jersey. Some of them might be in this call, but trust me, I'm not going to point out individually just for the legal purposes.
Of course.
But
Of course.
these are real people that have real issues, even in sub two. He sold his previous property, but he did not structure it properly, and unfortunately ended up having to pay a $46,000 taxes on something that he could avoid completely. So now what should have been zero tax, he's now having to pay 46 grand tax on it. That's when the planning phase comes in, is you plan on things in a way that you end up not having to owe anything, or even if you have, make it significantly low. I have another individual. This is from Illinois. Um, she is having a tremendous gain. I mean, huge gain, more almost $2 million in gain. And that's within a very short amount of time. Now, instead of a regular sale, what I'm trying to push her to do is a land contract where the actual execution is going to be uh, after the actual 1 year period. Then you're going to be treated as a long-term capital gains. And then instead of selling it as a traditional, do that as a 1031 exchange.
Okay. Let me ask you a couple of things. You mentioned a couple of things here. Some folks on the call I know are very, very sharp, very, very smart. I'm not one of them. I know a couple of things about a couple of things, but just to be the devil's advocate for a second, I know this answer, but maybe you could explain a little bit better. For those that don't know, what is a 1031 exchange?
So 1031 exchange is saying that I own a property. Instead of having a sale, I'm gonna be exchanging this property for another property. So that's the layman's term. Now, a little bit of one step above is um, you buy a property with it with the proceeds of the sale from a previous property within 180 days period with a 45 days selection period, and you don't recognize a taxable gain. So as long as you're not recognizing anything and you're not actually touching any money, but you're saying that, hey, I'm going to be pushing this capital gains later when I sell that one. And interestingly, capital with the capital gains or the 1031 exchange at the end, death eliminates that. So say, for example, you, JJ, build a $4 billion, $5 billion portfolio, and you have been building it with 1031 exchanges, and you have a couple of kids. Now they're going to get all of that as if there was no taxable gain realized for a significant part of that. Of course, they're going to be, depending on when they sell it, there's going to be other gains. And there's another thing that's called step up basis, which means as if all the gains that you had, the time of the transfer of the property, it's, of course, I'm making it super simplified. It's not that simplified in every case, of
Of
course,
course. Please do.
just to make sure if someone is in the legal terms, again, this is not a legal counsel. I'm just trying to make things as simple as possible
Yeah.
for the regular people so that they can actually go ahead and ask for the actual mechanisms. But on the outside shell perspective, the step up basis means is all of the gain that you had over the year, your heirs are going to get as if the price was at the time of your death. And now they're not going to be responsible for the taxes that was before you. And essentially, when was the taxes paid? Never. So that's the magic of it. That hey, you are going to be pushing the can of the capital gains taxes up until your death, but with your death, no one's going to pay the taxes either.
Wow. Now, on the 1031, and I've heard this before, that if you have a property, it increases in value, you sell it, you're making more than you paid for it when you originally got it.
Mm-hmm.
Now, let's say I bought it for 500,000
Mm-hmm.
10 years ago, 5 years ago, and I'm selling it for 1 million.
Mm-hmm.
Now I'd have to, if I didn't swing it over to 1031, I'd basically be paying tax on the million, right?
Tax on the 500.
Tax on the 500 above what I bought it for.
Yes.
I'm
So
paying.
you're going to be based on the gains, not the actual
Okay,
gain.
so to use different numbers, I bought it for 500,000
Mm-hmm.
5 years ago. I'm selling it for 800 grand.
Mm-hmm.
So when I sell it, I have to pay income tax on that 300 above what I originally bought it for.
Absolutely.
But if I take that $500,000 property, I sell it for 800 grand, but
Mm-hmm.
within the required time, I buy something else for 800 grand, then I don't pay any income tax on that gain, correct?
Yes.
So that,
Ideally, you would look for things much higher in value because then you can depreciate the next property as well. But if you are just buying at the same price, you're taking out the capital gains, but you're not able to depreciate the next property.
well,
You
and then
can.
like you say, if I'm buying something for 800 with the from the sales of the property, then I'm just paying it off as opposed to buying something that costs a lot more than leveraging debt.
Mhm. Yes, you're not leveraging that. Yes,
It's more beneficial for the investor to leverage debt and not pay that property off in its entirety,
absolutely.
but to use the future money by leveraging
Yes.
debt.
Now there's two components of it is the leverage and the basis. Now, IRS doesn't really care if you pay it off or not. At the end, the basis is what's going to determine how much of the gains of the taxes that you're going to be ending up with. That's why sometimes there's capital losses if some houses are underwater. In those cases, they would probably have to consider capital losses. And of course, capital losses have some limitations, how much you can or cannot take. But coming back to the point is, when it comes down to, if you're buying a property of 800,000, you're still having the debt on that 800,000, or even paying it off, depending on how you're structuring it. But now your basis is 800,000. What it means is, if you were to sell that property again, say for example at 1 million, now you're going to be paying taxes on 500,000, because now you have a previous basis incorporated into it. But if you were to buy $800,000, take leverage out, and then say for example 2 years from then you still paid sell it for $1 million, now you're saying that, hey, part of my money was paid out to the lender, but unfortunately you're going to be still subject to the taxes on that $500,000.
Mm-hmm.
That's why, just like note and the deed are not the same thing, similarly basis and the loan are not the same thing. So it is going to be pretty similar in most cases, because most people are not going to be leveraging it like that. But that's when it becomes really interesting for veteran investors like you, where you can play with the note, which is the loan, versus the basis. So here, whoever is you're sitting down with your taxes, make sure to understand that, hey, in this property, this is my basis. This is the taxable element that we're going to be getting hit with if we do sell it like this. And instead, maybe do a lease option with the option executed after a certain period. And again, in terms of capital gains, so say, for example, if that $800,000 property, you sold it within a year for $1 million, now that additional 200,000 would have been taxed at a much higher rate, which is about more than 30%. But the first one is going to be at 20%, because that's a long-term capital gains. So just by pushing the timeline as well, or the way you sell, might just be beneficial for you on the taxes. And that's one of the part of tax planning. There's three major components of planning. First is mitigation. When you say mitigation, is you're literally taking the entire thing off. So say, for example, instead of you selling it, you're putting it into a 501c3 and not recognize anything. The second thing is, depending on if it's structured correctly, second thing is you minimize it. In some cases, instead of just selling it, you just do a 1031 exchange, or even sell it as a seller finance deal. Now, even though you're going to be taxed the same amount, the difference is you now spread it out. So instead of paying the entire amount of $1 million, if you do it as a seller finance, like Pace bought one of his multifamily deal like this, they spread it out on a 50-year. The seller literally spread it out on 50 years, just because the seller is going to have a significantly lower capital gains tax rate. And the third part is diversification. So say, for example, you already sold it, you didn't do anything. Now, how can we diversify that tax amount with other vehicles? That's why, if you have been listening to Robert Kiyosaki, he's been saying, I have more trust on my Wagyu cattle than the dollar bill, because in some cases he can claim his Wagyu sales as capital losses, because those are treated as a capital asset against his real estate. And then that's how, if there was someone did something wrong, he could actually leverage those side as capital losses, still legally not pay a bunch of taxes. So those are some of the biggest part of the entirety of actually planning it properly, so that you're not getting hit with that, and being proactive on what you're doing. And of course, understand your long and short term goals and understand your strategies. Like someone might be having a strategy of commercial, someone might have a strategy of Airbnb. So that's when I understand that a lot of people here is into real estate. Like Andrew have been into so many things. He has been into new development, into old development. Now, whenever he's into new development, maybe he's also going to look into the affordable housing credits or into the opportunity zone credits. Now, if you doing the same thing in a different way, depending on how long his hold period is, he might not even pay any capital gains if he sold it properly, even without the 1031 exchange. So now, depending on how he's structuring his deals, maybe if properly structured, none of his entire thing, without the reasoning of the 1031 exchange, he can access that money without the leverage.
Wow.
Those are some of the things I would recommend. Sit down with whoever you're doing the taxes with, ask these questions.
Now, let me ask you something. I see all the time on Sub2 or Facebook, these groups, people are saying, "Do you know a good tax person? Do you know a good tax person?" Does your tax person generally, is it better for them to live in the state where your properties are, or some people have properties in multiple states?
Not really. That's why, because especially if he's a credentialed one like EA, lawyer, or CPA, we're authorized to do business in all 50 states. I mean, even some of the people with P10, most of them are also authorized for all 50 states, but New York, Oregon, some of those states have some special regulations.
Hmm.
But if your local guy is a CPA, a lawyer, or an enrolled agent, they have unlimited representation rights. So what I personally would look into, so say for example, I'm not an EA now, even though I'm an EA. So for the sake of conversation, I'm just an investor, a business owner. And all I do is I'm looking for someone who's going to be able to help me out. One of the primary things I would say is his mindset. Because someone can have 20 years of experience, just like real estate agents. If you bring them sub two, they're going to say, hey, I'm 28 years old. I've been in this business 28 years, more than what your age is. And you want me to teach that there's new other ways to do real estate business? Duh, yes. Just because you didn't spend the time to understand the mechanics doesn't mean those don't exist. So that's why I would look into the first thing is what are their mindsets. I understand that not every tax professional, like even me, I don't claim that I know every single thing in IRS code. That's not going to be physically possible. But
Yeah.
what I tell people that, hey, if you're bringing me a reasonable request to understand a strategy, I will go out and research that for you and come up with the reasoning and the ways to actually do it right. Because, like, there are ways to do something, and you need to do it in a certain way. So, say, for example, someone coming to me as a short term rental loophole or being a real estate professional. I, even though it's not an IRS requirement all the time that, hey, you need to have that record. But I tell my people that you need to give me that 100-hour log or the 750-hour log just so that I want to protect my clients in an event of any kind of audit. I try to do the filing as if there was an audit and what would I have done if there was an audit. And of course, there are gray areas. As long as you have a reasonable reason, I will be going to the gray area for you with you. And I will be fighting with you because at
Hmm.
the end of the day, we're going to be in that together if there is a situation like that.
Yeah. Yeah. So let me ask you, we've got we have experienced investors on the call, new investors on the call, and of course people watching on YouTube down the line. What do you suggest people look for when they go to seek out a tax professional? Are there certain questions we should ask? What should we look for? Do these people have to be certified by the state or have some kind of a educational status or something?
Of course, that's a great question. I mean, educational status is definitely, I would recommend, especially if, as I mentioned, those three categories, you can understand that they have to have a minimum level of education.
Is that
That's
what a
basic.
CPA is? Well, if someone's a CPA, they've gotten an education, they passed the state test. Is that what that means?
They passed an IRS test.
Okay.
So CPA, EA, and lawyer, all three of us have to go through the IRS, or lawyers go through the bar exams. So as long as these three people, again, now the second thing is I would look into is what are their mindsets? Because I have come across CPAs, EAs, lawyers that are like, hey, can I do it like this? They just say that no, and they just don't give them any reasoning or anything like that. Because when it comes down to that, is I hear that hey, then the same people comes to me and ask me the same question. I told my tax professional, can we do this? I'm like, hey, we can do this, but in such and such way. So he's like, then hey, as long as I could have known that, I would have done this like this. So it's not that you cannot do everything or nothing. It's just a matter of how you do that thing.
Okay.
And what are the points that you knew are going to be doing that. That's why the biggest thing I recommend is uh, look into the aspect of their mindset. It doesn't have always have to be a set of questions because
Yeah.
everyone's personality is different. But one of the things I recommend is understand how comfortable is he with something that whenever you're bringing in something creative,
So
whether
we
it's,
should
it's
look for
in real.
someone with experience then to some extent.
Repeat that again.
Well, and you mentioned one, we should look for someone that's experienced. We don't want to get a brand new tax guy. We want someone who's experienced.
Again, of course, experience is there, but one of the things, another thing is experience is going to be something that he can borrow, but mindset is something that he cannot borrow.
Yeah. Now,
That's why I recommend people with mindset first, then experience.
okay.
Because, say, for example, if I didn't have experience, just for the sake of our conversation on this one, I did not have extensive experience on multi-country taxes, but I am filing for multiple people this year who have real estate investment who has income in multiple countries. Making sense?
Yeah, no, very much so.
So
Um,
if you're talking about that perspective, yes, I didn't have the experience, but I had the mindset of putting them into a creative situation of how to legally save them quite a bit of taxes.
okay. I wanted to say, I have so many things I want to ask you, but I want to open it up to the people on the call. Alex, you are on the call with Tousif. What's your question?
How's it going, guys? I was just asking about the BOI report because I structured my entity so that I could have some protection when it comes to my identity. I didn't want anything, public and on there. So when it came to that, I was just wondering with that BOI report, that's gonna have to eventually have, connection to me on there. And I keep seeing like social media posts of like people promoting that, oh, trusts are actually exempt from the BOI. Make sure your businesses are inside of a trust so that you don't have to report and this and that, and to make sure that you keep the statements on for there. People keep suggesting, oh, don't worry about it. That's just information for like the banks and basically the IRS so that they can know who owns what and where the money's flowing. But I mean, that's the whole point because what we're doing is we're income shifting, like leveraging strategies and offsetting with depreciation, but also leveraging different strategies so we don't have to pay those taxes. Like he was mentioning earlier, some people might open up a 501(c)(3) and, you know, want to be philanthropic with their money that they generate instead of just paying it all to taxes. So I was just wondering, like, when it comes to that BOI report, I know I'm going to have to fill that out in January. I have to do something. So I did create a trust, but I was also recommended not to put my businesses in that trust if I want my children to receive the step up in basis in real estate, because once I commingle real estate with businesses in the same trust, that like conflicts somehow. And I was trying to understand how.
Let me,
Okay. You have quite a bit of questions.
yeah, I want to say,
Um,
what's your main question
It's
there?
just the BOI
so
report. I was wondering, I was like, is there any way, like, is that true? Like, do trust are they exempt from doing the BOI report?
Okay,
And
so the most reliable source you're going to be having, again, when you say trust, I don't answer direct questions to trust because when people say trust, general people, they don't have the difference on trust. There's so
Mhm.
many different type of trusts. It can be really powerful tool and it can be a really confusing tool. So that's why since if it's a question of trust, unless it's a one-on-one or very individual setting or a lawyer setting, I typically don't go into the details of trust. But if you go to the finzen.gov/BOI,
Mhm.
that is the most official source of information that you have. The exempt businesses and structures are going to be there as well. I don't remember the exact section name, but one of the tabs, if you go in there, it is going to have what are exempt, when are you exempt, and what other stuff. And when it comes down to the registration, you need to register before January. So it's not by January. So if you go beyond January 1st, 2025, you're going to be getting hit with the penalty of 590 each day. If your business was set up before 2024, January 1st, 2024, anything beyond after January 1st, 2024, depending on when it started, you have time anywhere from 30 to 90 days. So if you're starting brand new stuff, then you need to register them right away within the
Mhm.
30 days of formation, because otherwise that 590 a day is going to be accruing on you
Now, what do you mean register them? Register them with what?
with the FinZen. Finzen.gov. The website is finzen.gov/BOI. And just for information, it's more of a FinCEN thing than an IRS thing. IRS knows way better than, because even with anonymity structure, it's not anonymous from IRS. It's anonymous from public. Because IRS knows, because otherwise, how would they give you the EIN number?
That was
Like,
the word that I was looking for earlier. That threw me off. Anonymity. Anonymity. I can't even say it. But
Anonymity. Yeah.
yes, sir. And I was just like, man, I just learning about generational wealth and how to set everything up like Rockefellers, and my
that's a
kid
great strategy.
homeschooled. I'm raising her to, basically hopefully help me in my businesses, but if not, be able to be free and do whatever she wants. And at least she has the knowledge to be able to, do whatever she wants in life. And at least I structured it so that she could have a little bit, of a head start than I did, starting from ground zero.
Absolutely.
Like,
Especially with infinite banking, she could actually take loans against it
mhm.
and not pay any taxes for the investment she's getting. And that's another great planning, especially if you have into such a situation. I always recommend that waterfall method, especially you have a generational planning already coming up.
Did you call it the waterfall method?
Yeah, the Rockefeller waterfall method.
Okay, cool. Yeah,
I
I was
mean,
just honestly I was
it,
thinking about it yesterday. Like I've been doing this for like some time now, like following this financial journey, but I was thinking about getting that book. So is that is
what
that in
would
the
the
book?
Rockefellers do?
I'm sorry?
You're talking about the book, What Would the Rockefellers Do?
I'm not sure if it's that one. I think it's one kind of basically describing how they set up their businesses and kind of going into the entire indoctrination of like why schools were invented and everything like that, and how they live through creating those trusts and kind of like pass that generational wealth down. And the best thing we could do is just educate ourselves about history and to prevent the same thing from happening, understanding that there is a system and there's a way to learn the system so that you can use it to your advantage. Because a lot of people say it's to, oppress us and, to keep us down. But if and you're here in America, our parents come from other countries and stuff, like we have the opportunity. And
Yep.
my parents pushed on me, go to school, get a job. I dropped out of school, but I've always been interested in learning. I was just not in the right rooms. Now I'm in the
Absolutely.
right rooms with entrepreneurs, and I'm paying way less than I would if I were to go to a university to learn exactly the right niches and meeting the right people to get me on the right platforms so that I can be in front of the audience that I could connect to. And I feel like I've been procrastinating, but being around people like yourselves is making me fail forward and take that imperfect action like we were speaking of. I'm 28 years old myself, and I've been self-employed for over 10 years, and I've
Absolutely.
just been getting taxed and taxed and taxed, and I really didn't even appreciate that. So as soon as realized about tax strategy and that it wasn't the responsibility of my CPA to tell me, hey, you should do this, you should do that. It's up to me to be responsible, to be up to date with the knowledge, unless I'm hiring a professional to know what I'm doing so that I can leverage those strategies because it's all about time. Like you said, you need to know
Absolutely.
every day, every week, every month where your numbers are because you need to know if you're needing to invest in another business vehicle or if it should be real estate or if you can just shift some income by putting your kids on payroll or doing some more creative things.
And
But
even starting other businesses, one of the things that we think that we have to do it all in real estate is not always true. We could have businesses supporting real estate as well. One of the clients that I was talking to last week, he's a software engineer. Of course, his salary is not going to allow him to take bonuses against his personal income, but he's struggling with the property management. So I gave him ideas since he's a software engineer. Why don't you come up with a software that's the perfect property management software? Because trust me, no, I have not seen a single software that allows people to track their time that's going to be qualifying them for a real estate professional or
mhm,
short-term rental loophole, and
mhm,
also give them the proper idea on each KPI for each property, or have them track all the mileages. Now, you can do Stessa for the accounting, Mile IQ for the mileage, those kind of stuff. I think there's another app for the timing. Now, at the
mhm,
end of the day, you're like having either you have to have something, a platform to connect all of them,
mhm.
or you come up with an idea and have. He's also in sub two. I told him that, hey, just in sub two, there's more than 12,000 people. At least half of them have some sort of real estate management affiliation. And if we
Yeah.
could pass those through with them, if we can come up with the reasonable ideas and saying that would be a great business itself. And all the expenses on that business can be written off against your personal income. And even though your rental side might not be able to take the entire benefit,
Mhm,
but when you are at a portfolio that you don't need that, then all of your real estate can be written off against that.
mhm.
So that's when, whenever you're doing the planning, you're playing with a few things. One of them is the time. What is the time frame that you're going to be paying taxes on? When are you going to be paying it? 1031 exchange is one of them. Having a C corp is another one. You can choose to select one. What is going to be your tax year? Instead of
Off here,
January to
secret.
December, you can say, hey, mine is from July to June or June to July. The another can be using the proper structure, as you said, trust can be uh, something in Puerto Rico, having a business in US, or shifting from a single member LLC to an S corp and
Mhm,
paying yourself a salary. That can be another thing. The third thing is, what type of income is it? I'm having another guy who is trying to sell his business. Now, I asked him, what are you going to do after you sell the business? He said, all I want to do is real estate, full-time real estate. I said, okay, but if you sell this business together at the same time, you're going to be hit with a significant amount of taxes because you're trying to sell this at $6 million. Now, at 20%, you guys are looking at close to about $1.5 million.
Oh.
Then one of the ways is just maybe structured differently, make it as a royalty deal as opposed to a sale deal. That's why if you're looking into Shark Tank, Kevin O'Leary loves royalties because royalties and rents goes on the same schedule.
So,
So
I want to get back to Alex for a second. I thought it was a great question right off the bat about BOI was phenomenal. Of course, it's led us down this little rabbit hole here. I'd never heard about BOIs. Of course, I've got the website up here about beneficial ownership information. Now we're getting into C Corp versus S Corp and LLCs. But really quickly, I wanted to get back to Alex. Was Toasif able to answer your question or your questions? I want to make sure we got those answered for you.
Yeah, I believe so. I don't know if there's any way around it, but he also said that he can't really give that information. It's more like a one-on-one kind of thing because
Yeah,
it's kind of
yeah. I
legalized.
mean,
So
yeah. I
yeah,
mean,
it's always tough.
obviously on the call we're talking about his background, some generic things about taxes, and um, this is not a business call. This is not, professional tax consultation. We're just generically talking about some roundabout topics.
Mm,
I think probably the best thing, and Tosif will probably agree with me on this, is find yourself a good tax professional that fits your wheelhouse. One of the things he mentioned earlier was creative. We're in sub two, we're doing creative deals. We need to find someone that understands, all the aspects of that.
yeah.
Um, but you did bring up the beneficial ownership, and I think that's going to take me into my next question. But before I go there, was there anything else that we had for you that we could answer for you, Alex?
No, everything's good. I just wanted to say, hey, everybody, my name's Alex. I'm in the sub two group. If you want to reach out, that my information's right here in the group, and I appreciate the platform and the spotlight. Just to remember that when it comes to those tax professionals, there's this tax strategist and then there's a CPA. So you got to remember there's going to be two different people and try to find people who work well together when it comes to implementation because you can have a tax strategist that says, hey, buy a vehicle that weighs over 6,000 pounds so that you can take that bonus depreciation. But when you take that over to the CPA, they don't know what to do. So it's difficult when it comes to certain situations because certain CPAs may just deal with personal tax returns and some may kind of just focus on businesses. And when you go to the wrong person to the wrong, expecting that it's all one in shop, it waste everybody's time and it's just ineffective for you and the professional that you're dealing with because a lot of people do get angry with their CPAs like hey
Oh yeah.
a lot of missed opportunities throughout the years. I've been loyal with
And they
you.
can be both the same guy as well. Like I do planning sessions and I'm also an EA.
Hmm.
So
So that's
uh,
great right
you
there.
can actually have, that's why I brought up the mindset is if your CPA is only looking to file, as a business owner at my stage, I would not go with them. But if he's also looking for the plannings as well, if he's also offering those, probably hire them because I can ask much more questions than. And of course, there are people who provide separate services with just tax planning, strategizing. But I personally feel like if I'm the one who is going to be doing the both, I probably am going to be able to bring out much more benefits.
More
But
value.
I also work with a couple of clients who have tax strategists. And again, I work perfectly very well with them because if people who I'm working with know what they're doing, it's
Yeah.
really good to work with them.
There you
Yeah,
go. There you
I'm
go.
having trouble with that, so I'm happy that we connected today. I'm good. Expect a follow
You
up
have my number, my
from
friend.
JJ. JJ, thank you so much. I can't wait to hear what you have to ask, and sorry for
No,
throwing down
you're
a
good, but no,
random.
you're don't apologize for anything, brother. You brought value to the call, and that's exactly why we like to get questions. Justin Kremer, you are on with Toast. What's your question?
Toussaint JJ, thank you guys both so much for this. This is freaking amazing. For Toussaint, I have a couple questions. So first, I want to hear like what's your most bizarre tax planning story that you have? Like what's the weirdest thing that you've ever had to deal with from a tax planning perspective? Like, you know what I mean? Has something come up that has just been like completely you've never dealt with before that you've helped get through? I want to hear like something like that, like a, a success story, but maybe something that was just bizarre that you haven't dealt with before.
Oh, that's an interesting one. I feel like everyone is unique,
Yeah.
definitely. One of the plannings that I'm working with now is a overseas side as well. I would say it's when it comes down to success, I have not yet filed the entire thing yet because we're going to be filing the taxes of that next year. So I'm really interested in having that overseas limitations and stuff that to leverage. But in terms of that has happened, also it's up to student, short-term rental loophole. We were going back and forth quite a bit of time because whoever he used to work with before, he didn't communicate properly or didn't understand the documentation requirements, as I mentioned. Then we sat down, went through the entire thing, set up the documents, and he made 460, but he didn't pay any taxes.
Oh
And
wow.
depending on the way he did it, he actually got the credit and actually got back $3,500 without paying anything to IRS. So
That's
typically, what happens is you get refunds of things that you paid. He didn't pay anything, but still got back based on the refundable credit.
Oh, interesting. See, I love stuff like that. And then I guess my second question is if you had to break it down to like I don't know, like a top five steps or top three steps for people who are looking for a tax preparer, looking for a tax planner, like what would your top steps be?
The first one is understand. First one is reach out to a few, because
Yeah.
a lot of the people just see that, hey, I want to go to the local one. The one of the biggest thing I want you to get out of your mind is your most closest tax guy might not be the best guy for you. So most of the people I work with is all over the states. Uh, I have only 4 clients in Virginia. Everyone else is all spread out, out of almost more than 100 people that I have now. And one of the things I recommend people is first, look into, talk to them, reach out to multiple. Second is ask what their experience is. You might be having someone like I invest into real estate. So in terms of real estate, I have exposure. I personally invested into other countries to get the feel for what it takes for dealing with multiple country taxes.
Yeah.
So I have investments in 2 other countries than US. I'm looking for a few others. The third one is talk to them about creating mindsets. Like, what are the solutions they typically have understood, some examples, and if you're bringing in some uh, creative solutions, how open are they in terms of uh, incorporating those or guiding you to do what needs to be done? And again, fourth is whenever these things come up, do they help you with the documentations? Because as I mentioned, even though it's not an IRS requirement for people to show the tax professional that thing all the time, but I always recommend people to give me that timesheet. And say, for example, if you're using the S Corp strategy or C Corp, I tell them to give me the accountable plan as well. Even though legally I don't always have to ask them, as long as I feel it's a reasonable cost.
Mhm.
And the next thing I would also recommend is maybe ask your network as well,
Mm,
especially the people that are killing it. Ask about their tax professionals and are they satisfied with them?
yeah.
If they're not paying any taxes, so say for example, JJ is pretty satisfied with his guy.
Mhm.
Ask JJ is, hey, if you are you how much taxes are you paying with him? If not, if he's pretty good at not paying much of the taxes, maybe reach out to them. Reach out to, I think James is also on the call. James is also a sub 2 student. He's also a pretty good CPA. Maybe reach out to James.
Yeah.
Uh, talk to a couple of people and understand, hey, what are the aspects that we can leverage and how can we leverage those?
Mhm.
And again, at the end of the day, they're just like any contractor, any professional that you use, it's not going to be 100% in the first time, maybe. Just be clear with that. Because when I was working on my supposed flip, I was hoping that the first guy I go with is going to be the best one. Then it's good that we partner up with someone. He's told me that don't go with him.
Yeah.
Get at least 3 more quotes and then look into deciding who you're going to be going with.
I love that. That's amazing, man. Thank you guys again for sharing your wisdom with us. This is awesome.
Absolutely.
Mr. Mark Presswood and Yvonne. You guys are on with Tosef. What's your question?
What's going on, guys? Appreciate you dropping the gems today. It just makes me think even bigger, like the big company that has a big D and the happiest place on earth.
Oh,
And I was just like Googling that image for the office hours, and I'm thinking about their tax structure is pretty massive, right? I mean,
Like, say, for example, I know a couple of companies which are close, more than a few $100 million. Each department is structured different ways. So their main corporate structure is a corp. They have sub structures that are LLCs. They have other structures that are LLCs structured as S corps or C corps. So that's what's another thing that you need to understand. And also, what are you trying to do as well? Like, some people only trying to leverage debt. Other people are even trying to leverage their stocks, like the way Elon Musk did. When he needed to buy Tesla $40 billion, do you think he took the money from Tesla? No. He took loans against the share. So think about if he took money out of Tesla, which he could have probably done, but the moment he touched the money, that would have been a 20% tax. That means $10 billion would be going to tax of $40 billion. Now, instead, what he took is went to the people, said that, hey, this is my stock portfolio, give me a loan of $40 billion. And he got it. He bought Twitter, and he didn't pay any taxes on the money. And all the interest might just be another tax write-off on his new company as well. So he's having one company pay for the loan and not paying for that company of the taxes ever. So that's how you work things out.
yeah, I mean, this is where you really need help with professionals.
Sure. What's your question?
Yeah. It's just mind blowing that, I mean, it's a blessing here. We're taxed the way that we want to be treated, right?
Absolutely. And again, I understand there's another new thing coming up as the push, that capital gains from 20% probably going to be jumping to 45%. I have not read the full details yet. I have been seeing people sharing those. But another big thing, even worse thing, is going to be if someone is taxed especially even before being realized on the gain. So now you're going to be stuck with a double whammy, because with the appreciation, you might be subject to taxes. So that's another thing I'm telling people, that, hey, reach out to your legal representatives, tell people that, so that they don't come up with such crazy stuff. Because I don't like seeing people to pay a lot of taxes either.
yeah.
Do you think that this is why the Bitcoin was invented and all these cryptos and all this stuff?
I don't know. I'm not the guy coming up with the policies yet.
Yeah.
So if there is a time I'm going to be in Congress, maybe, but in that case, I'm definitely going to be pushing for, if possible, even zero taxes. That's how I think. But again, I'm not there yet. One of the biggest thing is, up until we are there, make sure to reach out to your local representatives and put your concerns that, hey, this unrealized gain is going to be such an unfortunate, because if the market collapses, what's going to happen then? Is the Fed going to give us the taxes we paid back? And that's when it becomes a little gray area on how those are going to be. That's why I'm telling whoever I'm meeting that, hey, reach out to representatives, have them post your concerns. And of course, inflation is eating our average American's savings and even regular income up. And if you're going to be putting us more taxes, let's not make our lives before 1880, because that, if you go through the citizenship test, one of the things that the independence war of US happened because of excessive taxation. If we go into that, what are we left with?
Yeah, exactly. So Mark, did we address
Yeah.
your question?
Yeah, I mean, I just saw a meme fly by on Facebook just today. It said, it was the mighty $100 bill is worth about 3 cents. So I mean, 97% is tax, right?
Yeah. Yeah, the key is
Anyways, I appreciate you guys. You guys probably blew everybody's mind on YouTube and the universe and everything today, man. This is a blessing. But thank you, JJ, and I appreciate you guys both.
So, I want to wrap up here because we're going a little while, but I wanted to talk about two things. Alex was talking earlier about having properties in a trust and they shouldn't be in a trust. We always hear about property should be in an LLC. So, from a tax standpoint, I know we can ask three different attorneys, get three different answers. You know, should properties be our income properties be in a trust, should be in an LLC? Is there any difference from a tax standpoint?
Okay. So multiple things. I'm not going to go into details on the trust side because it's going to, first of all, what type of trust? So I'm going to go with the very common types of it. The first thing, but I'm going to answer the LLC part first. If you are going to be having rentals on a broad stage, unless any special exceptions apply, I recommend appreciating properties to be put into single member or multi-member simple LLC, disregarded LLCs. That's my primary recommendations. Of course, there are certain exceptional situations, that's exceptional cases. If you have active income, even from the taxes, then even from the rentals, then I recommend probably having a separate management company, which is an S corp. The way you do it is you're going to be taxed 15.3% on Social Security and Medicare taxes, but on the part that you're going to be taking salary, but on the other side is not going to, the distribution is not going to be having that tax. But the reason that I still recommend people on the regular thing on Schedule E or 8825 is that's not always having that 15.3% tax. So just by having a single structure shift, you're saving 15.3%. Just by one thing. The second part is the trust structure. Now, there's many different types of trusts on a very big scale. One is revocable, another was irrevocable. Revocable has much better flexibility with what you're going to be doing afterwards. The problem is it has a very little amount, much lower amount of tax brackets. So you might be subject to a 37% tax bracket on your personal side if you're making, if I remember correctly, $600,000-ish. Someone can check out, depending on your marital status, anywhere from 300 to 600,000. But for irrevocable trust, it drops to, if I remember correct, less than $20,000, $30,000 and $15,000-ish. But it does not apply if it's if it's a revocable trust. But if it's irrevocable, that limit drops to that less than 20,000. Now, whenever you're into revocable one, then if it's a grantor trust, there's no difference between you and the trust. Technically, it's a legal veil for you to transfer things. But if it's a land trust, same thing. But the only thing it does is you're going to be paying the taxes on your personal side either way on a Schedule E or 8825. But down the road, your flexibility of what you can do with the property is limited. So all that functionality happens is, so say, for example, if someone is trying to avoid the due on sale clause on a sub 2, land trust is a very good way. Or even a grantor trust, maybe depending on which state you're in. If you are into trying to get a little more creative with the capital gains, and if you have some 501c3, then maybe move that into 501c3, then sell it. If you want to touch the money, get yourself a salary. But for your salary, have other stuff ready out. Because at that time, maybe put on that your personal W-2, you can contribute back up to 60% and reduce your taxable income by 60% of your W-2 side. So now, same property you're selling, the moment where you are selling it from varies what vehicles or what tools you have access to. And then maybe you need them, you have to sell that, you have to touch the money, but you want to spread it out. Maybe sell the thing on a LLC, or even sell the LLC, depending on how you're structuring it as a capital gains. Maybe sell that on a seller finance deal, or even Delaware statutory trust. That's
Wow.
another trust, but the difference is it distributes out the proceeds. The only thing with the DST is you have to let IRS know what the time frame is, and in most cases you cannot change it. So again, to answer your questions on the legal perspective, LLCs does give you a basic legal veil, but when it comes down to the much higher legal veil, legal litigation side, trust give you a better one. But the moment you get into trust, what type of trust you're having is going to dictate significantly how much income you're going to be making, or how much income tax you're going to be paying, and what other flexibilities that you're going to be having. Hope I was able to get a little bit more light on that.
Oh, brother, you were just dropping so much knowledge here. It's like it's literally overwhelming. So basically, we need to have a tax person on our team, CPA,
Absolutely.
and probably also from the sound of it, also an attorney on our team,
Absolutely.
so that we can get proper consultation, answers to questions from someone who we have a relationship with.
Mm-hmm.
Brother, you have dropped some unbelievable gold nuggets for us today. Hey, I want to kind of wrap things up because I know we'd go all day long with more tax questions. Um, I've got two last questions for you. If people want to follow up with you, I mean, are you coaching, or do you have a book out? You are a tax person, so people can go to you to engage you for assistance. Is that correct?
Yes. So we have tax services from basic bookkeeping all the way to CFO services,
Wow.
depending on which stage of business you're in. As a matter of fact, one of the things I'm trying to change in the tax industry is lack of accessibility. Uh, like people come up with accessibility stuff. They want to reach out to their tax professional, but they're like, hey, I cannot even get a hold on to them. So that's one of the biggest things I want to change in this industry is you can reach out to me. You have my personal cell phone. You can literally text me, and I typically respond within 24 hours. So that's one of the biggest things I'm trying to change in this industry. I do tax plannings from monthly sessions all the way to individual sessions, and I do file taxes. We do help people with their books, with bookkeeping, uh, pretty much all the basic accounting services to a little bit, I'd say, basic to medium level complex structures.
Okay. My last question for you.
Go for it.
Yeah, I've got a networking group, and I talk about the importance of networking all the time. You're a real estate investor, a successful investor, as well as helping people with their taxes and how they can save money. Um, we wonder, are the two things related sometimes? We have Learn Sub 2. There are many education programs that have a Facebook page for their community. They have new investors coming every day that are not experienced. They have new investors coming in that are experienced. They're coming to educational programs to gather knowledge, but they're not always looking to network. A lot of people think they know it all themselves. What is the importance of networking to the success of someone's business? And what might be the importance of joining a group like mine?
I guess the difference between my four businesses that I lost money and the difference between the three businesses that I made money is the networking. So one of the things, of course, I was like that, let me face it. Coming in from an engineering background, we're super introvert. We're used to speaking with machines more than human. So that's how bad I was. And that's how I lost so much money in four businesses. So if you think that you know everything, then there's either two things. One, you're super successful, you don't need to be anywhere, or you're super idiot. You need to change your mindset. Otherwise, you're just days away from being broke, like how I used to be. And one of the things is another thing can be is you have not done anything, because the moment you start doing anything significant, you'll soon realize that you cannot do it alone. That's when you need a network. Like, you're way better than I am on the social media. Just like today, I was fixing my social media page from you, just from the networking thing. And if someone wants to join this, especially for your side, you're giving away a ton of value for free. And I understand that people don't value the free education,
Yeah.
but when someone like me has to go to spending more than $50,000 in education and then sees a group like you, I'm like, you should have been friends much earlier. I could have saved 50 grand more. So that's the
Well,
difference. So I
you
don't
know
want
what?
to call out everything. I know people are intelligent, let them experience things. And if they want to spend that additional 50 grand before joining your group, I don't have anything else to say.
I'll tell you, my brother, I freaking love you. One of the things I say all the time, and we're all in business and we're all in real estate investment predominantly, and we're looking to make some money. But I always say, don't chase the deal, chase the relationship. Surround yourself with the right people, and your path should be quicker. If you guys are watching on YouTube right now, please like Tosa's video. Please put in the comments there what your takeaways were, what you found important, and possibly, how you think I can do better about what we're doing, how we can bring you a better product. Again, if you want to connect with Tosef, it's going to be on his Facebook page. Tousif Rahman EA is there. We showed it earlier in the video, and of course, we'll have it in the notes. If you want to connect with myself, JJ Zizian on Facebook, guys, please look for more stuff coming up on Flipside with JJ. We're going to have phenomenal guest speakers. I don't know if they're going to be as great as Tosef, but we're going to have great speakers coming up. And Tosef, we're going to see everybody in the world of virtual reality, right? Facebook, Instagram, and they can connect with both of us out there, right?
Absolutely. And most likely, I'm planning on having an all America business trip. Maybe I can meet some of you guys personally as well.
In Los Angeles. Come out to
Absolutely.
Los Angeles.
I'm looking forward to being at your place, brother.
Yeah, I'm looking forward to having you over. We're gonna have rock stars over at the house. And of course, we got this big picnic coming up in June 15th of 24. If you guys see this video soon enough, you got to come to California. Hey, everybody on the call, don't go away. We're going to do some live networking. Everybody watching on YouTube, thank you all so much. We appreciate you. And stay tuned for more. See you guys later.